Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's talk about trends a little bit and support and resistance. Basically, support and resistance. Prices come down to areas where buyers have stepped into the market in the past and have caused prices to turn higher. Usually what happens is a value trader thinks that the asset's undervalued and he believes it's a bargain, and so he'll purchase that. Also, if you see price come down to areas and prices turn and go in the opposite direction, many times other people will start to notice that, especially the longer it happens. This usually happens in a vertical trend situation. The validity of a vertical trend line is actually made stronger the many more times that it's touched. So if you see a rally, that just means that the number of sellers at that particular price level have dropped to zero, and therefore price must go higher to find sellers to shut off the buying. Resistance, of course, is a level where all of a sudden sellers have stepped into the market in the past. They've caused prices to turn lower. And of course, if there's a lot of sellers up there, they feel the asset's overvalued, or they're using some kind of a strategy to where they're hedging maybe, and they're using some kind of a put option, for example, in the currency markets. You'll see prices turn frequently at certain price levels. One level that this happened in recently in the British pound for almost the entire month of June was 165.50. Almost every time we rallied up there, prices turned for almost an entire month. So what happens is, if the number of buyers drops to zero when prices reaches there, then you're going to see prices fall away from that level, which we call a decline. The definition of a trend, and again, this is the basic definition of a trend, is a series of higher highs and higher lows in an uptrend. You really want to see higher peaks and higher troughs, higher highs and higher lows, which indicates, of course, that the direction is higher. Every now and then you'll have flat highs to go with those higher lows. That would be some kind of a consolidation pattern. We call an ascending triangle. But it's important in an uptrend that we constantly have higher highs and higher lows. And for downtrends, the same thing, lower highs, lower lows. Now, this is where I really like to separate my trends. I really talk about three different types of trends when I teach. The primary trend, the high time frame trend, the ones that are observed on weekly charts and daily charts, are the kind that last forever, as long as a business cycle wants to continue. I shouldn't say forever, I should say as long as the business cycle wants to continue. The business cycle, of course, expansion in the economy followed by a peak, followed by a contraction in the economy, followed by a trough. It's a repeatable cycle. We've seen this business cycle go very quickly sometimes, very slowly. Other times we've had long trends in the markets, short trends in the markets. A lot of what's happened recently with the turmoil that we've had in the financial markets has had an effect on these trends, but these trends are easily observed on high time frame charts. So for example, let's say we talk about the stock market uptrend we had recently. We rallied almost 40% off the lows in March, and during that time, of course, we had something called an intermediate term trend, which is just pretty much a profit-taking counter move to the primary trend. And of course, during that time, what's actually happening is everybody starts to question the reason for the uptrend. And you'll hear it all the time. You'll say, well, we've gone too far too fast and we need a little rest, or so we need some kind of a pullback or a retracement. And the thing is, though, is this trend is, it's pretty scary for investors because they never know if it's going to be a retracement or a reversal. Okay, so we're going to try to help everybody understand the difference between the two. I like to watch these trends on high time frame charts too, a little bit higher than the small time frames. So I usually use a 4-hour chart, which is a 240-minute chart, or a 60-minute chart. Now, in the Forex markets, most people love to trade the little tiny moves, which are short-term trends or intraday trends, which are actually random reactions to news and economic data reports. So all over the world, These reports get released all during the day, and equity traders, futures traders, Forex traders, everybody tries to trade these little tiny trends on small time frame charts, transaction charts like a tick chart, sometimes all the way up to 60-minute charts, just to try to profit from the volatility. That's dangerous, though. That volatility can really, really cost you. When I talk about support and resistance, you can also interchange the words supply and demand. I learned this definitely from a gentleman who's one of the instructors at the Online Trading Academy. I want to say it's been about 8 or 10 years ago that I first met Sam Seiden. Sam Seiden happened to be somebody who was a presenter at a presentation that I went to. I went to many, many presentations in search of knowledge. I was always constantly in search of knowledge. It's so much easier to get it now on the internet. That could be a curse or a blessing, really, because there's just so much out there. But I was really, really lucky when I met Sam because Sam made it pretty easy for me as far as trading goes. The chart you're looking at over here, I'm going to explain the way he explained it to me briefly. He used to actually work at the Chicago Mercantile Exchange in the Japanese yen pit. And he wasn't actually in the pit. He was outside the pit. He was answering telephones for a company and taking orders from institutional traders. And he was putting these orders into the market. And so what he would do is about 15 minutes before the open of the pit in the Japanese yen pit at 7:30 Central Time, he would organize his orders in a pile, and he would look down, and as soon as price got close to any of those stacks of orders that he had below, he would put those orders in the market. He would give them to a runner to take down to the filling broker in the pit, and that's how his job went all day long. So he was actually handling big orders. And he tells the story every time, and if you get a chance, I strongly suggest you listen to him tell it because, of course, I'm giving you it secondhand. But he would tell stories about how the largest stack of orders below current price would be where the buyers were, and the largest stack of orders above current price would be where the sellers were. And he would say that, well, what we want to try to do is see what that picture looks like on a price chart. And mostly that looks like a pivot high, which would be some kind of a resistance area. Prices couldn't go very much higher. And pivot lows would be some kind of a support area. So when he would explain it to me in the terms that he used, it made perfect sense because the institution would be the company that would call in the big order. They're usually market on orders to buy at the open or sell at the close. That's usually how they get in and out of the market. And so they kind of leave footprints on the chart if you know what you're looking for, which kind of gives you a clue where possible turns in price will be at some time in the future. Okay. Now notice that chart there that you're looking at, that cluster of trading above price. We will sideways for a period of time in this area here. All of a sudden we decline from that area. That's an indication that the number of buyers at this price level had dropped to zero and all that were left were sellers. And he would explain it that if that wasn't true, then price would still be continuing to trade in a sideways manner. The only reason that that candle closed below this area here was the number of buyers dropped to zero and there were still sellers. Now think about it this way, if that's institutions' orders that are sitting up there at a specific price level to sell, you can't fill those orders unless they go higher. So a limit order to sell would be at this price or higher. So it made perfect sense when he explained it to me. And the opposite picture at the bottom of the chart here, where this pivot low is and this rally afterwards, probably indicates leftover buy orders, unfilled demand, or buy orders. So he would also say when he was answering the phones, he had two sets of lines. He had the institutional line and he had the retail line. So when prices were rallying up here like this, he said the phones would be ringing and it would be the retail trader calling, trying to buy. And of course, if they were trying to buy at a price where he had a lot to sell, that wouldn't be a trade that worked out very well. Same thing down here. They'd be calling up, say, it's because they saw falling prices, and they'd be all excited to get short. And of course, if he's got five to sell at a price where there's 50,000 to buy, after the last buy order's filled, this trader's got a problem. Well, when he explained that to me, I kind of looked in the mirror and says, hey, I know who that guy is on the other side of both of those trades.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.